this morning. The Federal Reserve is widely expected to raise interest rates 3 times, maybe 2 to 3 times this year. JPMorgan Chase Chairman and CEO Jamie Dimon told me in an exclusive interview that he's focused on something else when it comes to the Federal Reserve and rates.
I always remind people the most important about interest rates is the why. Why does it go up? And I do believe you have a very good chance you're going to have rates go up a couple of times this year, but the why is for a good reason. Because the American economy is strengthening, inflation is going to where you want it, wages are going up, employment is going up. That is a good reason, and that reason trumps all other things. So you can point out some of the negatives from higher rates, but a strong economy trumps all other things, and I think that our economy has been okay and probably getting stronger.
Do you think that Fannie and Freddie will eventually become privatized in terms of housing, in terms of the fact that banks don't even do the majority of mortgages anymore? How do you get government out of the mortgage business?
You know, one of the things we didn't do, and partially because we have these regulations, there's so many people involved in mortgage regulation, we never finished them all. And you know who got hurt because of that? The American public. Particularly people who are first-time owners, people with prior credit problems, not bad people, but had prior bankruptcies, et cetera, self-employed, and it needs to be fixed. And so, but if you look at the mortgage market, there are good things to do and bad things to do. So hopefully we'll be part of that conversation. That one's fixable too. And again, don't make it binary. You can come up with many different forms that actually work for the American public and are safe. What you can't do is have a wish list of whatever you want and say that's what it's going to be, because embedded in that, so you end up with like a warthog, and it won't be a very good-looking animal, and I guarantee it'll lead to the next crisis.
I was listening to you in your conversation with your colleague just there at the healthcare conference, and you said, look, you got to get your head around higher rates. Yeah. I mean, somebody in a meeting said 2.54%. You said get your head around. Yeah. What?
Well, last year I was here, and they asked me the same question. I said, get your head around higher rates. And I said, it'd go up quite a bit more than 20 basis points or 30 or whatever's in the implied curve. I think when I was here last year, it was at 1.5 or 1.6, and now it's at 2.5, et cetera. Again, it could be much more than 30 basis points, 100 or 200. And I'm not saying, again, it could be for good reason. It's just things happen that people don't expect. As capital gets used, as growth goes, as the natural buyers of U.S. Treasuries basically are almost gone, which is foreign exchange managers and the central bank, you might have more volatility and higher rates. Again, as long as the America's growing, that's not the most important thing. The growth is the most important thing. If you had higher rates because of stagflation, that would be terrible.
Well, you said get your head around 3, 4, 5, 6, 7, 8. Yeah. Were you talking about the 10-year?
I always plan. I plan for the worst, yes. I'm not predicting it's going to go there. I'm just saying, yes, rates could be much higher in 5 years than you think. Don't be that surprised.
Would that be?
It's no different than when people are surprised that oil falls 50%, or copper goes up or down 50%, or zinc. Commodities, which money is, move, and they move dramatically with very small changes in supply and demand or sentiment. Just always keep that in mind.
Let me ask you about the consumer. You have a really great vantage point in terms of what's going on. I want to know about credit. I want to know about consumer spending right now. How would you characterize the health of the consumer?
I think it's quite good. Since the end of the Great Recession, I think, 16 or 17 million jobs have been added. Wages are going up. The last report shows that wages are going up pretty dramatically for the first time in 6 or 7 years. We have always seen credit spend, auto sales are all-time record. Home sales are going up. Home prices are up. So the consumer looks like they're strengthening. It doesn't mean every segment strengthened yet. And we all would like to see more strengthened at the lower end. But it seems to be getting better. The consumer seems to be in good shape.
Are there areas of the consumer that you think will get more impacted than not as a result of the incoming policies? I'm talking whether it be mortgages or retail or auto lending was one area that a lot of people were worried about. I
was not worried about it. I was the first to mention it might go bad. Auto lending is $1 trillion or something like that. A portion of that, some percentage, 30%, is subprime. It's rather small in the great scheme of stuff. But what we're talking about is it is getting a little extended. Mortgages before the last crisis were something like $10 or $11 trillion, and subprime, depending on measure, was $2 trillion. I mean, it dwarfs an order of magnitude. So I'm not worried about it. And I think if you have a general recovery in the economy, it helps everybody. Everyone complains now that middle-class incomes aren't going up enough, and very often people say things are not true. This one happens to be true. I think the growth will change that. I think growth will create more competition for lower skilled, and therefore give them more income. And I think it's a good thing for America. We need that in America today. And there are people who have been left behind, and we should be doing something to do it. And even business should be doing that.
How about credit cards?
Credit cards have been doing great, but when you go through a terrible cycle, you usually have a good one, and so spend has been going up. We're more in the prime, so you have to talk to someone who's more in the subprime area. But credit card credit has never been better, and it's going to get worse, but not because it's bad, just because it's never been better, and you should expect it to tick up a little bit from here.
So you don't worry that people are getting a little extended again? I mean, are we going too far now?
No.
Okay.
No.
What would
If you look at the asset prices are up, okay, home prices are up, employment's way up, those all drive credit, wages are going up, okay, and so if you look at credit, it's actually all the underlying things about credit are good. Home prices are a big part of people's assets. Having open jobs and the ability to move are a good part of what people look at when they look at credit. So most parts of consumer credit actually look pretty good.